Good morning, traders and investors. My name is Roger Scott, and today is Wednesday, October 6th. Believe it or not, but today's my 20th wedding anniversary. Can you imagine that? 20 years ago, I got married today. Still very happily married. But anyhow, let's talk about market action. It's about 7:42. The market's going to be opening up in about, let's see here, a little less than 2 hours. Again, overnight, we're down. We've been in choppy land. I mean, choppy land. The Nasdaq is down, the Dow is down, everything is down. And looking at the global economy, it looks like we're trying to find reasons for this. But the bottom line is it's just technical volatility. The ISM service index yesterday came in at 61.9. Anything below 50 is contraction. Anything above 50 is expansion. We came in above. So the ISM services index doesn't look bad at all. The supply manager survey doesn't look bad. It was a positive yesterday. Today, we don't have a lot of numbers, but we do have ADP, employment data, which reflects on the employment situation. It's a private report that'll give us a good understanding of how the job market is going. Now, I don't think this correction is due to anything at this point. I think it's just the market volatility, and the market is recalibrating itself. And look, it's been trending for a long time. Look at the consumer discretionary sector. This is all-time high right here a few days ago. Looks like we're just fluctuating. It doesn't look like we're really going in any directional movement. Volatility is high, but we're not going anywhere. Similarly, look at the bond market. I want to show you this. Yeah, I mean, it's going down, right? I mean, it's going down, but look at this envelope. The envelope, it's still a choppy envelope. So the market doesn't really have clear direction right now. Look at the Dow Jones. Look at the Nasdaq 100. I apologize. We're almost at the 200-day moving average. And again, we haven't really been doing anything. We've been kind of just stuck around these levels. So I'm not really seeing anything crazy. I'm not seeing crazy directional bias. Matter of fact, I was looking this morning at the number of stocks making 90-day highs and 90-day lows. And if you look here, you've got 113 stocks breaking down. You've got 86 stocks breaking higher. There's just not a lot of momentum behind this. And then if you look at the put-to-call ratio, again, look at that. 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5 days above 100. So it looks like the market is trying to bottom out. If we were here and the volatility was really, really high, I would be really nervous. But we're already above that threshold. So it looks like that rubber band is now stretched out to the bottom side, like it was stretched out to the upside, and it's doing this. And remember when we were making all-time highs, I said till we contract, we really can't go higher. Well, in this case, till we contract, we can't go lower or higher. So we have to contract. And that means we have to go back within this range and volatility has to come down. But the bottom line is it looks like we're bottoming out. And if you look, let me show you, put the call ratio as I showed you, still above 1, which means we are on the downside. Volatility via VIX, it's at 23 right now. I mean, yeah, it's above 20, but I mean, it doesn't even go above this level that we peaked out last week. And it's been going lower, and 20 is not a big level. I mean, 23, 24, look at it historically over time. I mean, it's just not that big of a level. We're not here. We're not here. We're not even here. We're down here, 23. So it just doesn't look like there's much going on. And I mean, look at global economy. I love these writers. There's no real reason for the market being down, right? So look at what they do. I want you guys to see this. The market's down, but there's really no reason. There's nothing new that's causing the markets going down. So they put everything into their report. Global shares slipped in cautious trading Wednesday, shrugging off a rally on Wall Street, led by technology companies, banks that erased most of the losses. Worries remain in Asia about ongoing COVID infections. Wall Street still expecting solid corporate profits when the third quarter earnings season kicks off later this month. S&P companies are projecting to post a 27.7% increase in earnings for the July-September quarter versus a year earlier. 27%. That's bullish. But the bottom line is there's really troubled real estate developer Evergrande risk of defaulting has already alarmed investors. But there's nothing new here. There's absolutely nothing new. So can the bond market go lower? Yeah, but we've already priced in. The Fed told us right here that they were going to take action. We're now here. I mean, are we going to go lower? The bond market's pretty choppy. So, and also look at momentum levels. The RSI, we're at 10 on the RSI right now. So we could go lower, but statistically, it just doesn't feel that way. It doesn't look that way. And again, if you look at all the sectors, and let's take a look here. Just feels like the market is trying to shake us out before going higher. That's what momentum levels are looking at right now. So these are the 11 sectors. And right now, oh, come on, work for me here. I can't get anything to work today. Let me see if I can do it this way. Let's see if I can get my filters to work. I don't give up that easily. There we go. So as you can see here, these are my 11 filters. It's like Murphy's Law. It works all day long except when I'm doing a video, right? So energy, financial, technology, consumer discretionary. These are not defensive sectors. Utilities is defensive, all right? Consumer staples is defensive. These can go either way, but energy, financial, energy goes up when economy expands. Financials goes up when economy is expanding. Technology, consumer, these are the most. So I just don't see a major bear market. A pullback, a correction, a little volatility, absolutely. But a bear market, nothing is pointing to it. Now, I know it's Wednesday, and what do I usually give you on Wednesday? I give you a long trade, and I give you a short trade, an actionable one. So today, let me show you what I'm looking at. Now, for the long side, I'm looking at Albertson Companies. This is a supermarket chain, and typically when economy turns a little bit south, supermarkets, people start shopping for food. They go out less. They spend less money on going out and more money on dining in. The stock is hitting the 50-day moving average just now. It's not in the twilight zone like most stocks. We're coming off of recent highs, and with the market action being where it is, I think we're going to pull up from here. So I would be buying this at the current level, and if we break, let's say go to the 26, I would dump it. And I would hold this all the way to the 34 level. And if you're an options trader, I got something for you too. Let's go to the 12/17 expiration. And let's go to the 30 strike price. You know what? Actually, yeah, 30 strike price looks good. These options right here, 30 strike price expiration. Right there. You'll probably end up paying about $2 for it, $1.90, $2, somewhere in that area. But the 30 call I really like here. And again, if we look at the chart, you will see that it's pulling back to the 50-day line. If it really breaks down, we dump the call. You'll probably get out at like 30% down. And if we break higher, if we break above this $32 level, we'll probably test new highs. And if we can do that, that call will probably be worth about somewhere in the $4 to $5 area. So, and again, assuming this all happens in the near term, not over the next 2 months when the price of the call comes down. But then you'll be in the money anyway, so time value won't be a big deal. So again, I like this, and I still think we're shaking out. At least that's what the markets are telling us right now. The short side, notice on the long side, break out to the high side, pull back to the 50-day moving average. The 50-day moving average is above the 200-day moving average, and the RSI is not overbought. To the short side, trend down, swing low. The 50-day is below the 200-day moving average, and we're pulling back up to the 50-day line. Now, in here, this is MSC Industrial Direct Companies. This stock is just not doing well at all. So I would look to sell it around the $81 level, right around the current level. And if it goes to the 84, I would get out of it. And if it comes down to the 77, 76, that's a profit target. And in this case, I would be looking at puts. And if I'm going too fast for you, just rewind this video, watch it as many times as you need to. And again, I don't have a crystal ball, but these stocks just don't look all that great. Here I would go to puts. We're at 82 right now. I would look at puts. I would go to the 80 strike price. Not a lot of liquidity here, but something to get you guys off on this trade. You can do the 80. There's enough liquidity. Or you could do the 75 or the 80. I would go for the 80 because it has a little more intrinsic. Let's see, does it have any intrinsic right now? No, it doesn't have any intrinsic actually. So 85 or 80, one of these two, probably 80 is good enough in this case. And you'll probably end up paying somewhere around $4 for it. That was the last, I'm assuming the market's going to open up on this stock, either where it is or lower. So again, MSC Industrial, you want the December 17th expiration, monthly puts, 885 strike price. And on Albertsons, you want to do the 30 strike price calls that are expiring December 17th as well. Now, before I let you go, I want to show you guys something else. And this is really important. I want to show you the RSP, the equal weighted SPY. Look at the choppiness, the level of choppiness. It hasn't really been going down, right? It's been just choppy. It's been, let me see, can I draw a circle? I'd love to draw a circle or something. Eclipse is fine. This is choppiness. This is not a directional market. And if you look at IWM, the Russell 2000, you will see that it's actually trading above the 200-day moving average for the most part. That's kind of bullish. Our lows have been getting higher. Now, today we're going a little bit down. I'm hoping we're going to come up from here. But again, the highs, we've been going higher. Again, I just want to review this because I know a lot of people are nervous. I've been getting a lot of emails. Market momentum. Let's just do this real quick. Market momentum. 90-day lows, 113. 90-day highs, 86. That's a choppy, choppy market. If you look at the indices, if you look at RSP, which is the equal weighted SPY, gives us a good indication of how the market's looking right now. You will see choppy. The put to call ratio still stretched out to the downside. Still above 1, which means the market is oversold. All right. Volatility, nothing really that crazy. Oh, sorry, that's put to call ratio. VIX. Let's do VIX, volatility. I get confused because they both have a dollar sign in front of them. Still right at near the $20 level, nothing really crazy. And again, as far as sectors that are leading, I mean, you've got, let me just do this here. You've got financial, energy, and tech, and consumer discretionary on the upper side. So I'm just not seeing it. Now, data. Jobless claims tomorrow is going to be a big report, and employment situation. And if employment situation is a little weak, I don't think the jobless claims is going to be off. I think we'll be right at the 320, 350,000. But if the employment data is a little off, look for bond market. Look for this bond market to trade higher, not lower, because then there's a good chance the Fed will continue pumping money into the market, and that can actually cause an upside rally. So don't. I know that volatility is going crazy. I know a lot of people are hurting right now, but try to keep a perspective of what's really going on in the big picture. And the best thing you could do right now is lower your exposure. Don't try to outguess the market. Lower your exposure right now. Now, folks, I want to end this with something really, really important. Legendary trader Tom Busby, he's widely considered to be one of the top traders and researchers in the industry. After his 30 plus years of trading professionally, actually it's 40 years. I thought it was 37 and a half years, but it's actually 40 years. I've only been doing this for 27 and a half years. He's figured out a brilliant way to use a little known secret. And it's all thanks to a loophole in the market that's powered to create moonshot trades. Moonshot trades or 10 to 20 cent option contracts. Tom finds these loopholes on the secondary market. Now, some people, they've never heard about the secondary market. It's completely overlooked part of the options market that most traders and investors don't understand or even know exists. But thanks to Tom, everyone can now use this access to get amazing opportunities, profit opportunities, and moonshot trades. You don't want to miss out on moonshot trades and great profit opportunities. Click the link below and learn how you can access moonshot trades and learn more about this little known secret. And don't forget to subscribe to this video and watch this on YouTube. Stay ahead of the market by being the first to be notified when I post my next video like this, giving you a 15-minute market analysis. And folks, tomorrow on Thursday, we're going to talk about top ETFs, the worst ETFs, the best ETFs, and options that go with those ETFs. So don't miss tomorrow's pre-market session. I'll talk to you later. Bye.